Well, I got to figure out how to use this thing properly. So if you see me fidgeting around and poking at it, just trying to let me play a bit while we're just getting started. Chat filter. Let's go with all. Now, how do I see who's here? Let's see. Start a poll. Start a question and answer. What's this one? Pin to live stream. Anyway, I hope everybody's doing. Whoops, I don't want to hit cancel. I hope everybody's doing well. Hopefully this week I have the microphone on. Last week I think I went a good 5 minutes or so before I even realized that the microphone wasn't even on. I'm still trying to figure out how do I see who's here. Oh, that's highlights. We don't know. That's not. I don't need retouch. Well, maybe I do need some retouch. Um, Anyway, I hope you're all well. I've kind of written out some things depending on how many people show up just to get into, which is some discounted stocks. I've even gotten into like the channels that I watch too, because I think these guys do a good job and I find the content really interesting, among other places that I watch as well. Um, and then if you want, we can go over my trading account as well. And of course, as always, please, if you guys have stocks or anything, it's kind of nice to be in front of the computer. I can pull it up. I can do a quick research on the company, what I see for their earnings, and if I think it looks attractive in terms of a purchase potentially, or to own, or if I don't like it. Because quite honestly, even when I talk about the stuff I look at and what I watch and what I invest in, I really do try to limit it to a certain amount of companies because I think there's a point where when you watch too many, you can't pay attention to any of it. So a lot of the times when people ask me about a company, especially God forbid when you guys ask about ETFs, I'm really not necessarily familiar with them. But it's so simple to go online and get information and do the research in a rather short amount of time to have an opinion, especially, I, I like charting because I'm more price sensitive to than anything else. And I find the charts can give me a good feel of where the companies have been and where it looks like they're going, although, of course, not always accurate. I can tell you, myself included, I begin to have concerns about the markets and if they're a little overstretched because I'm catching myself doing certain things that typically I do when markets are overstretched. Like, for example, I've been talking about Bitcoin and crypto and that stuff. And when I start paying attention to it, it's probably gotten a little too far, to be quite honest. Um, I tend to trade off of my own emotions, and often I'll fade my own thought process. When I think something is really looking great, sometimes that means it's gone too far. And when I think it's looking terrible, sometimes that means it's gone too far the other way. So I really do try to pay attention to myself and my own behavior to actually do the opposite of what's going on in my brain, which is why I think it's important to kind of have an attitude of being able to be contradictive to what's going on in the markets. Do the opposite of what everybody's thinking. Now, that being said, in terms of my long term stuff, I don't make any changes. I buy and hold and own for multiple years. In fact, the video I did yesterday was a little bit about, I talked a lot about McDonald's stock. And of course, I picked it on purpose because out of the ones I picked when I was a kid, it did phenomenally well. And the other ones actually went out of business, which when I've done the stories in the past, that's kind of part of the point of the stories. Um, it's really interesting that I picked 5 companies. I was probably like 17, or I had to be. Did I drive myself to? Yeah, I had to be over 16. So I would say I was about 17 or 18 years old at the oldest, and picked 5 companies total, one of which I can't remember for the life of me and has been driving me nuts for years to try to remember which one it was. But Eastman, Kodak, Chrysler, and GE in the form that it was back then no longer even exist. And just McDonald's on its own has actually performed well enough that it wasn't it was actually a decent investment. And I also collect dividends and other stuff, and oh, I had Chrysler too, which is out of business. So maybe was that all 5 of them? Maybe it was. Either way, 4 of the 5 go out of business. 1 still performs well enough that you do well in the investment, having no knowledge of the economy, which is why I try not to pay too much attention to earnings and growth and the things that we really should pay attention to. And as I've gotten older, I look at, but I kind of take it with a grain of salt because i- if you're planning to own something for 20, 30, 40 years potentially, and if you're not, pay different attention. Does it really matter if you're buying the low or buying the high or whatever it is in the cycle? Because over 30 years, that number really isn't going to matter a whole lot other than bragging rights. When I bought McDonald's in 1988 or 89, somewhere around that timeline, did it really matter what I put away back then? If I put $1 million, so Texas Hauler is asking, if I put $1 million to invest, how much return can I expect? It's a really loaded question, Texas. It depends what you mean. There's no guaranteed return to be won. The stock market on average seems to yield about an 8% return year over year, but there are going to be years where it makes 20%, and there are going to be times where it's down 50%, and usually that comes in a very short amount of time and really surprises people. If you're asking about retirement and how much can you draw off of it, they have a general rule of thumb of you can take about 4% a year. And the reason for that is the hope is that if you take 4%, hopefully it's still getting about 8% in terms of the over timeline. And by taking less, you're able to keep up with inflation as things get more expensive over the years. Now, that's a judgment call in my mind. That seems to be a general rule of thumb about investment, retirement. Um, but it really depends on your goals and how you invest it. None of that's guaranteed. And typical disclaimer, this is entertainment purposes only. You need to do your own research and potentially even reach out to a financial advisor for advice. But it really depends how you invest it. I mean, if you put all million, to over exaggerate, into a company like Palantir, either you're going to crush it or you're going to get crushed. If you buy a bunch of Johnson and Johnson companies and things along those lines, or Colgate Palmolive, you'll probably underperform that 8%, but you'll probably be able to rely pretty well on their dividends, and as long as you pick the really good ones. So I always kind of say, in general, it really depends on your goals. Doing either a real self analysis of what you hope with that money, what you need with that money, and how you'd like it to perform. Of course, everybody wants it to do the best, as well as your own risk tolerance. Because if you pick something that's a little bit risky when it's down, are you comfortable owning it? Okay, Texas Holler is saying he saved 1 million, and I'm looking to invest. Which again, if I think that's great. I would still reach out to a financial advisor depending on, if do you want to just be invested in the market. I made a comment in my video yesterday. There are a lot of ETFs out there that are no brainers, that are really easy because they diversify you and take a lot of the guesswork out of it. Or do you like picking individual stocks, and how do you want it to work for you? What I recommended, I don't know a ton about Acorns. I thought that was just an investment platform. I don't know. Is that a stock to invest in? Let me see if it's a, or is that just to use them to invest the money, or don't they? I don't know a ton about it. I don't like anybody who invests for me if they invest for you. But I thought that was just like a platform to be able to invest on. Um, but what I told my wife and son, because my wife finds all of this annoying. Like, she doesn't like the market, she doesn't wanna think about it, she doesn't wanna pay attention to it. So I made her write down SPY and QQQ. So SPY is an ETF for the S&P 500. I if it's me, I'm comfortable putting 100% of my money in the SPY. If I don't wanna pay attention, I don't wanna think about it, and I just wanna be invested in the market. It's taking the 500 top companies, and it's spreading you out, and even though it feels like I'm not diversified, you really are. The QQQ is the Nasdaq 100. It's another 100 stocks. And what I had said to her is, take 50-50 or 60-40 or 70-30. And, I'd weight heavier in the S&P if I was picking one because the QQQs are a little bit more risky, but it's a good way not to think about it. And then there's a zillion other ETFs as well. A lot of people like SCHD, which is a Schwab one, and it has less thought process going into it. And while it feels like, geez, I'm taking so much risk by putting it in these things and not spreading out, they spread out for you and they do all of that. And the what's improved so much over the years, like when I was younger, you had the mutual funds that would do it for you. But they charge, 1 or 2% typically. And while they've come down because they have to compete with the ETFs, like I want to say, let me see if it shows on here. I think the SPY charges like 0.05 or something for their expense ratio. I mean, it's like a joke. So you don't have to worry about the investment company gouging you or anything like that. Like, that's what's so great about most of these ETFs. Yeah, it doesn't show on here, but either way, um, you're spending like $5 on every 10,000. Like, it's really inexpensive to invest in a lot of these ETFs. And then even here, it's not a huge yield, but it looks like the SPY pays a 1% dividend, and let's see if the QQQ does. So, retirement. Since you said, I believe it's a retirement account. I generally would recommend, if you wanted to pick individual stocks, yeah, tiny dividend. It pays about a point, almost like a little less than a half a percent. But if the account is one that you want to be able to draw a check from, I think the 4% rule is a pretty good one. It's a low end basic. You should be able to take out 40,000 a year. The account should still be able to grow a little bit. And if it's me personally, since I like picking individual stocks, uh, I would find stocks that pay dividends, and that way I don't really have to think about it, and I collect on the dividends, and I just pick 20 of them and spread it out and see if I can find stuff that averages around 4, maybe 5% return. If I want to press a little bit, look for things that might be out of favor right now, but that make enough money to be able to pay their dividends. Like, one of the one I did a list of discounted. Yeah, that was what I was referring to. Texas Hunter was asking 4% rule. There is a general rule of thumb that an investment account that you can pull out of it about 4% a year, and the account should grow at a pace to keep up with inflation, and you can use that 4%. The problem is, not a problem, you have to kind of do an analysis every year, because if the market has a correction one year and you have less money in it at the end of the year, you have to adjust to what it has in the account at the time that you're taking the 4%, or you spread it out over time. But if I were picking stocks, I would put it in things like Pfizer, Bristol Myers, Target, NextEra Energy, Procter and Gamble, Coca-Cola, companies that have been around a long time, and I'd probably pick 20, maybe even 30 of them if I want to be more conservative, and look at their dividend rates and maybe just not pay attention to the valuation of the companies and hope that they're able to pay those dividends and potentially even grow those dividends. And then I would just try to stick with the companies you know the names of and that you're comfortable with. And then when the dividend checks come in, you could just use those to live off of and not pay too much attention to the stocks as long as you're comfortable that they're good companies. The one analysis I'd recommend doing is making sure that they're making enough money that they're able to pay those dividends. So whatever stocks you pick, I'd look at their annual income, I'd see how much the dividend pays out, and then say, are they making enough to be able to pay that dividend and still survive and continue to grow and possibly even grow the dividend? Otherwise, um, any other way is just fine too. And right now, if you really just want to guarantee a return, high yield savings accounts and treasuries. My only concern with them is interest rates are really sensitive right now and could go either direction. That I wouldn't, me personally, it doesn't necessarily mean it doesn't make sense for somebody else. I wouldn't want to pick up a 10-year bond or a 30-year bond, excuse me, just because I'm wanting the guaranteed 4.5 or 5% rate that it's paying. Give me a second. My morning coffee that I do iced coffee. um, because I wouldn't want to commit. Like I do think of my money in something like a treasury as me lending the money and getting that return. I wouldn't want to commit my money too long for 4 or 5% long. Well, I'm glad that it was informative. So Texas Hunters, this is really informative information. I appreciate that. But I like this stuff. I've always found it interesting. I think some people do, some people don't. I think YouTube is a great place to go to learn and get a lot of information. Um, Spotted stars, yes. He is asking chat, is this real? 100%, this is real. I can do whatever you like, and I'm happy to answer the questions. And I like having the back and forth, and I like the live platform. I think it's super cool. I hope I'm able to grow people who come here because I do like going over all of this. And what I've said in a lot of my videos, the reason I do this is my hope is to encourage people to save. Um, I'm a consumer on YouTube as well. Like I watch a lot of channels. And when I see the gloom and doom ones, there are plenty of times that I think they have good points and maybe they're accurate and maybe a crash is coming, maybe not. Like I don't think there really is one, but I get hyperbolic and sometimes I think it's coming. But what I don't like about the gloom and doomers and what they're selling is I think they encourage people not to invest, like telling people to just wait for the future because the markets are going to collapse and blaming the government and the data points and saying, it does nobody any good. So spotted stars, let's see. What are your thoughts on contemporary geopolitical status of gross tax income of corporations compared to how it was in the 1970s? Sounds like an economics class, and I don't. I just think it's well, what I think it's kind of funny. Anyway, I don't know. Um, I think everything has changed since the 1970s. I don't really have much of an issue with it. I do think the CEOs probably take a little bit too big of a salary, but it's also what draws them into getting the best people to run the companies. Other countries like I think it's Japan, and I forget the ratio, but the CEO can only make I think 500 times the lowest paid employee at a company, which encourages them to raise the minimum payment of their what they give to any employee at the company. In terms of the taxes, the problem is they have great accountants and they get smarter and smarter about how they manage things. I don't know, I'm not educated enough to know the changes of what the requirements were from the 70s versus today. But I'm guessing even if it was punitive, that the accountants that the companies are hiring are better than the ones that are being hired by the government, so they'll find ways to beat the system. Um, Texas, oh, that's funny. But if there's a thought that it's gotten unfair and the corporations don't pay enough taxes, while it may be true, it may not. And we want to encourage, at least myself included, I want to have companies around giving people jobs and helping the economy grow. So I'm not sure there's a great solution to a lot of the questions around, and look, I am not a conspiracy theorist. I do not think the government does things on purpose to hurt this or help that or whatever. I do think when the guy gets in charge and he owns a certain company or he's on the board, he's going to have policies that might be favorable to that company, which of course. But I think most policies are set with good intentions. I think all the riders in there of 800 promises to this guy and that guy just to get him to sign my bill is a bit of a problem. And I think that's a little bit of just the system. But I think what happens is it's a good intention where they haven't been until you do something, you don't know what the repercussions are. So you set a policy with good intentions, and then the outcome ends up being that people figure a way to take advantage of it. And on hindsight, it's really easy to look at it and think, gee, that was so obvious. Um, Billy, thank you. So Billy Johnson, who I see often enough, is saying my Ulta pick has done really well. Thank you. The funny thing is with Ulta, so I picked up Ulta and Lululemon at around the same time um, because I thought they were highly discounted. There was a story not long after that Warren Buffett bought Ulta Beauty and it shot the stock up. I know it's done well since, but I got out after that point because nothing. Look, I really respect Warren Buffett. How could you not? But I think it's kind of silly when a stock goes up because somebody else bought it. Um, they're overvaluing his ability to time the market at this second. Warren Buffett has a tendency to hold companies 30 years or so, which goes back to my point about does it really matter what you pay? Like you look at his Coca-Cola trade, which everybody points to as genius, and how he cited this undervalued company. Well, Coca-Cola's just done incredible over 30 years, and if he paid too much back then, I don't think that would have changed anything. They've just managed to do very well with a pretty conservative long-term growth, and if you stuck with it and reinvested with anyway, thank you for the compliment on Alta. I got out of it a while back and it's gone up further from there, but I was perfectly content taking that move for the reason I was mentioning, which is that seemed kind of silly. I got super lucky on Lululemon, and I said to my brother, it's kind of funny, and when stock generally, when I buy a stock on the larger side, I put about half of what I would want to put into the stock, which is what I did on Lululemon. I actually wanted to buy double what I bought, but generally the stock will go against me for a while. Like it's really rare that you buy something and it just goes straight up like that. From time to time you do, and it kind of get lucky. And I kind of kick myself that I wish I put on the full position, but I'm really lucky that it went up as much as it did. Um, my thought is I'll put on about a quarter to half of what I want, and as the stock goes lower, I'll try to gauge when I think it has bottomed out to where I put on the full position. But both Ulta and Lulu just never pulled back. Now I'm trying to decide which I meant to buy it for long term, but it's moved so much in such a short amount of time. That's when my brain starts going, well, do I just take the money off the table and move it into something else I think is discounted? Right now, me personally, I feel like Target's probably undervalued. Nextera Energy, I don't know how many of you are familiar with them. And I know I touted for Nextera Energy Partners a lot in some videos, maybe 6 months or a year, probably a year ago or longer. What got me looking at them is they're a subsidiary of Nextera Energy, and they have a really high dividend that I was over attracted to. The reality is, I think Nextera Energy is a great energy company. They're out of Florida. I think they're the biggest in the country, and they do kind of, gravitate towards renewable type of energy. I think with AI and crypto and the demand on energy that we're going to see over the next 5 or 10 years, anything in the energy space is probably a decent investment. Thing is, they tend not to do and like you're not going to crush it on them. They're big and boring and they don't go up a ton. Um, but I think it's actually a little bit discounted right now. I think you're getting a really good bargain. When when the election finished, they figured that it won't do well, but the reality is I don't think any of that impacts some of these companies, and they go about their business and they do just fine no matter what. But I also had Pfizer and Bristol Myers in there, and then of course I think Google's super uninvested. Um, so Texas Hunter, I put 30K on a Tesla stock last year. Well, of course, and it stayed stagnant for a while. But yeah, it's risen extremely well. I think it closed the week at 380 or something. Let's take a look. But I know in the past few months the thing's taken off and it was stagnant for a while. It's tough for me with Tesla. uh, And look, I have a tiny bit in there as well. It it's so overvalued in some ways. I mean, it's trading at a current valuation of 100 times earnings, and everybody's betting on the robo taxis and all the other stuff. The interesting thing is it's a lot of institutions, and they're usually pretty smart about what they invest in. But for example, like GM is trading at 5 times current earnings. Uh, you, but Elon has a foot in the door of the White House. I'm guessing that there'll be some things that come along that he has some favorable um, policies, and maybe robo taxi and maybe the autonomous driving, maybe that stuff pushes on a little bit quicker and easier than people expect, and maybe there's something in those earnings that work out. I we drive Teslas. I can't say enough about the car. Yeah, 289. Wow. Wow, it really went up there. I can't say enough about the car itself. We bought one of the ones in 2014, and my mom wanted to cut my head off because the technology was still new and thought it was a big risk. And what if the battery dies? And what if? And what if? And she's probably right. And I ignored her anyway. That's what kids do, right? Um, and have been unbelievably happy with the car. We've had it 10 years. The battery hasn't degraded as much as people think. No oil changes, no going to the gas station, no timing belts. Like, there's so much less maintenance to the car. And when I think about the time I used to spend, like, I don't think I ever want to go back to take 2 hours out of my day and get an oil change 2 or 3 times a year, depending on the car. And then they're really easy to drive. I think there are other cars that are put together better. Like, I do think that the German cars, like Mercedes and BMW, the lines are better. Like it's just a heavier, well built car. But my car, the one that we bought in 2014, is my wife's car. Kind of died. It just got to the point that it was old and time to get a new one. And when I looked at the cost of a Tesla and the rebate and really all their sales pitch is legitimate, it was a no-brainer of what to decide to get. I didn't really look at anything else. I just kind of let's see. So Jacksonville kids, since that accident with those 4 kids in Piedmont, California, and the Tesla truck, I've been watching fire videos that the fire department have challenges putting out. Yeah, they do have challenges putting them out, and it's happened a few times, but it isn't. I've taken the risk. I'm not sure really what causes those fires and when the batteries overheat or if it happens in accidents. Um, but there's all sort like with other cars, they have issues too. I'm not trying to belittle it. Um, I just know from my own experience, we've had the car 10 years. It, over the entire 10 years, if I take out of like typical what everything has with tires and windshield wipers, if I ignore that, because I have had to get new tires a few times and that's not cheap, we spent less than $500 on the car in over 10 years. Um, that blows my mind away. That's why I said no timing belts, no like nothing, and we haven't even had to replace the brakes. It has over 130,000 miles, but that regenerative braking, if you start to get used to it and you drive it where you really only use the gas pedal, you don't really use the brakes very much. So that's what I love about the car so much is the lack of maintenance. And then not even going to the gas station is really nice too. We pull into the garage, we plug it in, and then I'm cheap enough and lucky enough, they gave really good incentives the past few years to do solar. We added solar, so we don't even pay any more to charge it. Like our electric, I don't, I think they're great cars. And then what Tesla's really smart about, even though the price to earnings ratio is really high, and it's really high, they really bring everything in house. Like I I do my insurance, my auto insurance directly through them too because it's like a third of the price of when I looked outside of Tesla. So I can't believe how inexpensive the insurance costs. And I'm guessing it's because they know their true costs and they can make a little bit of money. Like I don't know that, but it would make sense to me. And the person who I use who does my insurance, she outsourced, like she kind of brokers, so she's not committed to just one insurance company. She'll shop around for the best deal. So it floors me how much less expensive it was because part of the reason she said that the insurance is so expensive is what Tesla's done with the market is if you use any non-Tesla parts for anything on it, you've voided the warranty. So that causes the insurance to be expensive because the parts are expensive and. Well, if you're Tesla itself and you know the true cost of the parts, maybe you're just in a better position to be able to offer insurance at a discounted price. And along those lines, you sell the parts to people. And then you actually own the equivalent of the gas stations as well. And over the years, not only is their market share gotten bigger and bigger and bigger, and they have a ton of places across the country to be able to charge your car. When you get there, there's more and more cars at them. So they've opened up more, and there are more cars. And at least here on the West Coast, because my father came out to visit from New York this past weekend, and he made a comment like he can't believe how many Teslas there are on the road, and I feel the same way. I mean, every car, and obviously that's an exaggeration, you drive past feels like it's a Tesla. You stop at a light and there's three of them, in the group of 10 cars. It's just incredible how many of them there are out there. And I think that's the discounts and everything else. Their attitude is the more market share we get, the more we get on the road, the more service appointments, the more like I said, they really control every aspect of the car and generate revenue in ways that the other auto companies are probably going to learn from. Even their subscription model. I mean, they sorry, I'm just unplugging something. They have a lot of add-ons that you can pay monthly or pay annually for the car, which really interesting way of doing things. Even just how you have a technology package that you can pay $100 a year and then another $4 a month to get XM radio or whatever it is. And they've incorporated all these things in a way that should just continue to generate revenue month after month after month. So I love the company. It's still hard for me where it's trading now. I just don't know that I'd be buying here because it seems so overpriced. Doesn't mean it won't go a long way further. And to be quite honest, chart looks great. Looks like it's going straight back up. And to your point, it really like, I mean, October it was still trading $200. I think I bought 5 shares for my mother-in-law like really recently, in the hundreds. So yeah, the thing's gone out of control, but it could have a long way to go. I guess we'll see. And I just don't, their growth rate just isn't that big, but maybe they get the robo taxi and everything else. I kind of put on my list like right now. I love Google and I love all the bad news about it. Bad news on great companies is usually a really good thing. And I saw the CEO Sundar talking a few times, and I liked what he had to say. And their growth has been just fine, despite kind of what he was saying is a lot of things that people are pointing to as threats to them just make the market bigger. It doesn't mean people necessarily leave the market, and it doesn't mean that Google has to do worse for the other ones to do well. And I thought that was a really intelligent comment and makes a lot of sense. Chat GPT doing well does not necessarily mean that Google now has to lose customers and do worse. It just means people are using Chat GPT as well. And maybe it's drawing more people away from things like television onto the computer or whatever it is. And it just makes the marketplace bigger. If you look at Google's earnings and if you even pull out their search, it's continuing to grow at a really good pace. And that was kind of what he was pointing at. He's like, as these things have come around and people are talking about how it's taking our business, well, they're doing really well, but our business is continuing to grow at a great pace as well. So why does one have to be, reliant on the other? And I think he's right. And I love, even though it's a 0.46 yield, that they added a dividend. I know it sounds so stupid, but I also think that by it being so small, it gives great opportunity for it to be able to raise it a really high percentage rate. I mean, if they raise the quarterly dividend from 20 cents to 22 cents, that's a 10% raise. And God forbid they go to something like 25 or 30 cents. They're raising it 25 to 50% depending. And I think that's a cool way to start things and just continue to grow it. Um, I talked about that a little in yesterday's video as well. So if you guys have time to watch it, I'd probably take a look. Where when I bought McDonald's, it was paying like $12 every quarter, and even back when I bought it, that was kind of silly. Now it's actually over $100. So over time, if you're in a company that the dividends raise and consistently do so, it could out back to what uh, I think it was you, Texas Hauler, was asking originally. That's why I like those things is they kind of can keep up with inflation as well. That's my hope. So I also wrote down because I wanted to kind of give a lot of them a shout out. If you guys don't watch, these are the YouTubers who I really like their channels as well. And I find that they have really good information and really good content. Um, I'll start with Joseph Carlson. I don't know if you guys watch him, but he does a really good analysis, and you can even go back in time and see how he's performed. He's performed extremely well, and it's one of the reasons I've been pushing to narrow down the amount of stocks that I put in the account that I use for trading, because I think if you focus on the best ones and really stick with them, they can really perform. And you have to really be convicted and trust them so that when they're going against you, you still believe in them. But he does a really good analysis of breaking down earnings and things of that nature and why he sees growth or a lack of growth in companies. And I also like his picks as well. And it'll off topic, but on topic. It's also why I always give that disclaimer of you have to do your own research. So he recently talked about booking.com, which has done extremely well. And I liked his analysis. I don't have anything invested in the travel space. And I thought, geez, I really like that. Let me put a little in booking.com. Since I hadn't done the research and I hadn't picked it, it went up and I was all too excited because it wasn't my pick. I hadn't done the research. So I got out and it continued to go up immensely. And when I listen to his videos and he's still sticking with it, it reminds me of like the companies that I do my own research on as well. Because if I pick the companies and I trust them when they perform, it's not like I'm all too excited to take a small profit because I bought them for a different reason. I believed in the companies and I think they're going to perform over time. And even after they've gone up a short amount, decent amount in a short amount of time, I find if I get out, even if I'm right for a short amount of time, in the long run, hopefully they do what I wanted them to do. And eh, by me investing in the stock that he picked, I mean, I think he mentioned it on his channel when it was trading around. I know this will be a high dollar amount, but I think it was trading around 3,400 or 3,300 a share, and it's up to 5,000. And I didn't even make it to 4,000. I was all too excited when it was up 100 or 200 bucks. So do your own research. Make sure to stick with the stuff you trust. Um, Another person I watch who I really like. Thank you, Ashish. I appreciate the compliments. That's very kind of you. Thank you. I really like Ari Gutman, and I'll mention Ryan Williams as well. The only reason I'm mentioning them together is they've started this kind of like almost like a podcast where they do this, conversation piece, and I think they both do good analysis. Ryan really sticks to dividend stocks like wholeheartedly. Ari used to, and he's beginning to gravitate to some growth stocks mixed in as well. And for his age, I actually think that's really smart. I love dividend stocks, but I think if you're in your 20s or 30s, you want to have some growth stocks as well. And I understand that there are some growth dividend stocks, but if I'm buying growth dividend stocks, I'm really looking at Google, Meta, Apple, and Microsoft, not Johnson and Johnson because I think it's still growing at that age. Getting to my age, I'm beginning to think, geez, maybe I should have some more of the Johnson and Johnsons and stuff because when there's a downturn, because there will be, and I'm not saying it's coming anytime soon, but the markets go up, the markets go down. The big boring Johnson and Johnsons don't generally participate quite the same way in the up moves or the down moves. So when you get older, like me, they probably make more sense to be in some of those less exciting, boring type of investments and not have the risk like Meta or some of the others. Now, since my background is trading, it's very hard for me to gravitate out of those because I see the growth and I always want the growth. But for Ari, I thought it's a smart decision to start focusing a little less on the dividends and just going with the companies he thought were best because he's so much younger than I am, and he has such a longer timeline. If they have pullbacks, they have a lot more time to come back out of those pullbacks. And I find the companies that are the growth companies will tend to do better than the ones that are more mature and growing less along their lifeline. Stocks have a lifeline as well. Another person who I really like is Russ Dapper Dividends out of Chicago. And I just think he does a nice analysis. He focuses on dividend stocks as well. I think all four of them have great channels. I like what they talk about. They have a good balance of, you know, research as well as I like their analysis on that research. And then there's some real estate guys who I watch as well, but I watch them more for entertainment purposes because they're a little bit gloom and doom talking about the real estate collapse that's coming. Now, to be fair to them, when I look at the price of real estate and where interest rates are, monthly payments are expensive. But I don't know that that's not just inflation the same way that a carton of eggs have gotten expensive. Excuse me. it doesn't guaranteed um, that there's going to be a correction. As we mature and as regulations get tougher and to be able to build new uh, residential properties, we do have a supply and demand issue. And some countries have been exorbitantly overpriced for a lot longer than us. And maybe we're just getting more mature and we end up like some of those countries. I mean, go look at property in London. Like, it's absurd. And how does anybody afford it? So I get that we seem overextended and maybe they're correct, but I watch their channels more for entertainment purposes, like I talk about with mine, just because I think the negativity on those channels really encourage not investing. And again, like I hope to encourage people to save and put away. And it doesn't have to be in what I talk about. It doesn't have to be in stocks. It doesn't have to be in real estate. There's all sorts of investments. I mean, I don't care if you like baseball cards or wine or art. Just make sure that whatever it is that you're looking to invest in, you're really knowledgeable and you're an expert in that field. The reason I don't invest in a lot of that is I don't know the market well. And the only thing I've learned over the years is if that's the case, you're the guy that's going to get taken total advantage of. So that even if you're right, that you won't be profitable because somebody's ripped you off so much. And you're likely to also be the person who buys the fake or the wrong this or the wrong that. So my real advice is really know what you're investing in, but there's a zillion investments. I'm sure you guys know about stuff and whatever it is you work in that ends up being an investment as well. Like the original iPhone, but I started looking at it and there's a whole bunch of them. And, I get you want new in box and in good condition or whatever else, but I don't know which one is the one that, anyway. There's all sorts of things to invest in, and I hope to encourage people to invest. So, one of the real estate guys I listen to is Jerry Abbott. He posts, oh, I almost forgot, ex dividend investor. I really like him as well. Every Saturday, he does a videos that he does, and I find it really a really good video. Um, and I actually don't miss that one on Saturdays. I like his once a week videos. Um, but Jerry Abbott, that's what made me think about it. He does once a week on Saturdays as well. I like his content, and he's actually moderated off a bit because I think he sees similar to me. He was very bearish the market. He saw a collapse coming, and he's tapered that off about a little bit. And at this point, he kind of notes that it seems expensive, and he talks about sellers who are overzealous and list too high and how much they have to lower the prices. But to me, that's just real estate. People think their own home is nicer than anything else and worth more than it typically is. So they get a little overzealous. They list for too high and they have to lower the price. Now he shows it as, the market's crashing and look at how crazy these people are and everything else. But it was much more negative and bearish before it's kind of tapered a bit. And then I listen to Michael Bordenero, who I like a lot, but I kind of feel the other way around. He's gotten so gloom and doom and so unrealistic. I don't know if it's just to build the channel or anything else. I still like his content. I want to have the data he talks about. I listen to it. I find it interesting, but I hate that he's gotten so negative and talks about this, pending doom and gloom where the economy is going to crash and life is terrible. And the reason I don't like those things, especially when you get into the comment section, how many people agree and that the government's ruining their lives? And like, I think that puts people in a rut where they don't look at the ways to get out of things. They just sit there and everything's so negative. Why would I save? Um, and then Orlando Minor, who I find very entertaining, but can't like I rarely agree with his opinions, but I also find the channel entertaining. The things I don't like about his channel is he almost laughs and makes fun of when people are doing poorly. And I think that's a terrible behavior. But along the lines of what Michael Bordenero's like, he's negative and always like the discussion is about not investing, and then he'll flip around and say, I'm a licensed lender, So if you're looking to buy something, reach out and I'll help you be able to buy it. And I think that that's kind of funny considering you're telling everybody that the economy's terrible and you shouldn't be buying. But I guess that's his what he does. So the last one on my list who I put, and I saved him for last, is the same reason. He's just so negative, which is Travis Spencer, and he's a little too emotional about it too. You know, yes, housing is expensive. Yes, interest rates are higher. But I will tell you, the market ebbs and flows, and it tends to get too busy and then too slow. And part of why I don't think there's a real collapse coming is uh, I think COVID taught the government a lot of ways to support the market if a real collapse started to come. Uh, Unfortunately, I think that's bad behavior. I think the point of a collapse is it takes some people out of the market who are overstretched and creates an opportunities for really discounted properties where new people are able to get in. And it does help the economy and it allows the younger generation to find opportunities to buy property. But I don't think they want the crash if it comes. And like I just said, I think COVID gave them a lot of weapons that they realize if a collapse does come, they have things in place that they'll do to stop it. So I don't really see a big housing correction. I think we could correct 10, 15%. I've seen inventory pick up, but I also don't know that I really see that happening. And I don't really see rates going down as much as people hope for either. As long as the economy is strong, there's just no reason. What I envision is if the Fed's able to cut the overnight lending rate, that the yield curve just normalizes more and more to where it's a little bit like it used to be. And maybe the short end is down to 3%, but the long end is still 5%, which puts interest rates or for mortgages probably in the sevens, which is about where they are now. I know people feel like that's absurdly high, but you know, that's only because it was so recent that it was absurdly low. Over the long term, it isn't so absurdly high. And it's kind of why I try to think of this stuff in generalities. When it was down in the threes, I used to have conversations with friends that how I would never lend money to somewhere for 3%. And at 3%, I'll borrow as much as I can. Now that it's hit 7, it's not like I'd be sitting there looking to borrow as much as I could. It's a little more attractive, but still, if I wanted to lend money for 30 years, am I comfortable? Just get like, don't get me wrong, 7% is decent return, but I still have risk. And I don't know that, like, that seems about where it should be. 6 is, oh, did this freeze? I see the time going. I'm still yapping. Are we there or did I lose connection? Uh-oh. Well, if you guys can hear me, boy, forgive me, Sarab. I hope I'm pronouncing it correctly. Oh, it is still going. Okay, it's frozen on my end. Thanks, John. My opinion on a 60/40 portfolio, I think it's great if you have enough money that can support retirement. Um, all of the concepts really depend on one's personal financial position because if you have enough money, like why take the risk? Maybe you even go 80% in the bonds, like whatever makes sense. And if you need to generate more income or you need the account to grow, you have to be realistic about where you are, what your expenses are, and how much is in the account and what's realistic for it to be able to make. 60/40 is great for the people who have the right amount of money that works for them. Um, my end of it is you know, perfectly honest, I spend too much, so I have to try to make enough per month without working to be able to meet how much like what I envision where I'd like to be able to spend, and make sure that we have enough of that coming in. You know, I'm really so my job allows me to work if I have my phone, I can get 80 to 90% of my work done. I have enough support at the company that there are people who I know will help or get answers or whatever they need. And during the summer, when my son's on summer break, we take a very extended vacation. 14 years old, the time is flying by. It gives an opportunity for us to hang out and my wife too and see places and do things that I never did when I was younger and never imagined that I could. It's super cool, but it's an expense. So we need to make sure that there's enough, that we can to build the portfolio, that there's enough to be able to live the life that we want to be able to live. It's also very easy to cut costs and downsize and whatever else if we needed to. But my hope is to be able to grow to enough to be able to sustain it that way. There's all sorts of things on the spectrum of where somebody is, and you have to do the math of what you live like and what your monthly expenses are, factor in for inflation that it's going to continue to go up and life will get more expensive, or where it's fixed, like if you own your house and you have a mortgage, the principal and interest is not going to go up, but the taxes and insurance will. And use a general formula to kind of guesstimate what that would be. But your cell phone bills will go up, your gas prices, life gets more expensive, so you have to account for that, and then see where you stand in terms of your bills and how you have saved, and then there's all sorts of avenues. Like I said, it's why I love this stuff. Is there a zillion ways to skin the cat that all make sense to whomever it is that's looking? So so I constantly look and I look for solutions and try to watch the markets and be careful, but things happen that that you don't see coming, and it's not so, they say buy low, sell high. Well, if you look at the charts and where the collapses were and think about what was going on, it isn't so simple, which is why we have all these conversations, because when the markets drop, it's because it's the 1987 crash, or go back and it's the Great Depression, or move forward and it's the internet bubble, or it's the housing crisis and the bank crisis. Like, what's going on when the markets are at the bottoms is really scary. And it's hard to just step out and say, oh, it's too cheap, I'll buy here. It isn't as hard when the economy is doing fine and certain individual stocks are doing that. There's more confidence. But same thing, when things are falling, the news is bad. And when things are going up, it's because news is good. So it makes it rather difficult. And it's why you have to be a contrarian and look through that noise and see when the news just makes sense, that, geez, that's really bad news that I think will pass in time. And when it's over, this is a great company and it'll rebound and do just fine. Or this is bad news and this really changes the fundamentals of this company and I don't want to be around watching it. It's very hard to do that. It's just hearing the narrative, making the decisions that you think are best and trusting them. The best advice I can give. I hope it helps people. Um, does anyone have any questions on any specific stocks or anything before we call it a day? We're actually going to go put up Christmas lights shortly. I am the, um, let's see, we have the greatest Christmas display of any Jewish family I know. Um, but I'm not real religious. I just think it's funny in some ways. We have all sorts of nutcrackers and reindeer and Santas, and we do all the lights. And we fell behind because we went out for Thanksgiving. I hope you got to see the picture of the brisket that I made. I was very happy with it, how it came out. But generally, I think I smoked it for, God, must have been 18 hours. I started amazing. Anyway, all right. Well, hopefully it was still going. Hopefully everybody has a good Sunday. I will probably be here next Sunday. I toy with the idea of changing the time because I'm wondering if it's a little early on Sunday for a lot of people. So maybe we push it a little later. I hope your portfolios are doing phenomenal. The indices are making all times highs. I hope you're enjoying it. I hope that everybody's doing great, and have a great week. I'll see you guys next week.